One of the biggest risks that retirees face is called sequence of returns risk. In a nutshell, sequence of returns risk is the risk of a sharp drop in the stock market early in your retirement. Because you still need income to live off of in retirement, withdrawals from your portfolio while the market is down can significantly impact the long-term success of your plan. In this video, we're going to look at a white paper by JPM Chase that I think does a good job of visualizing sequence of returns risk. After that, we're going to discuss 3 different ways that you can mitigate this risk in your own plan. Hey everyone, if we haven't met yet, my name is Jake Skellhorn. I'm a certified financial planner and co-owner of Spark Wealth Advisors located here in Florida, where we help people across the country retire with confidence and clarity. As most of us know, the long-term average return of the stock market is about 10% per year, depending on exactly what dates you look at. But rarely, if ever, is the stock market going to give you a 10% return on any given year. What I mean by that is, sometimes the stock market could be up 20% one year, could be down 15% another year, up 3%, down 7%, etc. So again, sequence of returns risk is the risk that you're going to have one of those big down years as soon as you retire. So when you're withdrawing from your portfolio, let's say you withdraw 4% per year, but the market is down 15%, then your portfolio is actually down 19%. When you're 10 plus years away from retirement, this isn't really a big deal because you're not drawing down from the portfolio, and historically that's been plenty of time for the market to come back from any of those short-term dips. But when you're in retirement and you need income every month, it's a whole nother story. So let's look at this graph from JPM Chase's study on sequence of returns risk. As you can see here, there's 3 different retiree scenarios here. All of them have a couple assumptions. They're starting retirement with $1 million. They're planning for a 30-year time horizon, or essentially a life expectancy of how long they'll need that money for. Their portfolio earns an average rate of return of 5% per year. Again, that's the average. And they plan to withdraw 4% of their portfolio at the beginning of retirement, adjusting upwards for inflation each year. This is obviously known as the 4% rule. So while they all earn an average of 5% per year, each retiree is going to have a different sequence of returns. So retiree A, which is this middle line, they earn exactly 5% per year. This is obviously a fairy tale scenario. This would never happen, but just for illustrative purposes, it's showing you how predictable your income would be over your lifetime. So it starts out pretty much flat because they're withdrawing 4% while their portfolio is increasing 5%. But as the years go on, their portfolio need increases with inflation, so it slowly starts to dip into the principal. But they're left with $585,000 at the end of 30 years in this example. Retiree B, which is the purple line here, they have a great sequence of returns. So they start retirement with a series of positive years so that their withdrawal need is essentially becoming a smaller and smaller percentage of their portfolio. Now, they do experience bad returns at the end of their retirement, but at that point, it really doesn't matter. They're actually left with more than they started with after withdrawing that 4% every year. So they have almost $1.6 million left over, which is one of the issues I have with the 4% rule in general, but I'll digress for the rest of this video. Retiree C, which is this blue line here, got the short end of the stick when it comes to their sequence of returns. So they basically had a series of poor years in the stock market as soon as they retired, and because they were withdrawing from their portfolio at the same time, it was never able to recover, and they actually run out of money in 22 years rather than having a significant chunk of money left over at the end of 30 years. So this is obviously the scenario that you want to avoid at all costs. So there's a few different ways that you can plan or mitigate this risk. I've narrowed it down to 3 in this video. There's other ways as well, but for the purposes of this video and keeping it simple, we'll just cover 3. Number 1 is using annuities. So by purchasing an annuity with a portion of your portfolio, you're essentially transferring that risk of the stock market to the insurance company, and they give you a guaranteed monthly income for the rest of your life or you and a spouse's life. So by transferring this risk, you are essentially increasing your spending floor since you're getting that guaranteed income, and you're relying less on your portfolio so that it's not damaging it if the market is down. There are retirees who like to buy an annuity that would cover all of their fixed expenses, such as housing, groceries, utilities, things like that. And then anything that's left over, they keep invested in the stock market and they can use as discretionary spending and cut back on that spending if the market is down. I would also put Social Security claiming in this same bucket if you wanted to claim Social Security earlier than initially planned to reduce sequence of returns risk, since Social Security is essentially an annuity in and of itself. So by claiming Social Security early, you're going to be relying less on your portfolio as a percentage of your total income each month and each year. So just as a quick example, let's say that you plan to retire at 62, but your initial plan is not to claim Social Security until 67. So in those 5 years, you're going to need a withdrawal from your investment portfolio. Well, if based on your desired spending that withdrawal comes out to, let's say, 6 or 7% of your portfolio for a few years, you face a pretty significant risk that if the stock market drops, you're going to be withdrawing a significant amount from your portfolio and again, damaging the long-term success of your plan. So if claiming Social Security early at 62 instead of 67 means that you only really need to withdraw 3 or 4% of your portfolio each year, then you're probably going to be better off long-term. You're going to reduce your sequence of returns risk, even though you might receive less of a payout over your lifetime from Social Security, but it's a risk that you're mitigating nonetheless. The second way that you can mitigate this risk is by using the bucket strategy, which a lot of people are familiar with. But essentially the bucket strategy is taking your portfolio and dividing it up into 3 different buckets based on when you expect to need that money and investing it in different securities accordingly. So the bucket strategy can be customizable, but the baseline scenario that I like to use when I use it is putting about 2 years worth of expenses in extremely safe assets like money markets and CDs. Those are essentially guaranteed while also providing you a little bit of interest. So 2 years of expenses in bucket 1. Bucket 2 would contain another 3 to 5 years worth of your expenses and would be slightly more risky assets, not necessarily FDIC insured, but still relatively safe overall. For example, government and corporate bonds. And then bucket 3 would be any assets that you don't plan to really rely on for income for at least 7, 8 or more years. And that would be basically your stock bucket. So the idea here is that if the market does drop, your stock bucket is the only one that's really going to take a hit, but it has 8 or more years to recover before you're really going to need it. So with the bucket strategy, if the market drops, you're going to pull first from bucket 1 without touching your stocks or even bucket 2, replenish bucket 2 as the market recovers, or potentially pull money from bucket 2 if the market has not recovered in time. But historically speaking, the average bear market doesn't last anywhere near 8 years. So that's the idea behind the bucket strategy, is segmenting up your assets into different buckets based on when you're going to need that money. The third solution to mitigate this risk, and my favorite as a financial planner, is implementing a dynamic spending strategy, which in layman's terms means you are willing to adjust your income based on market conditions. So a popular method for this is called Guardrails, where you set a starting rate of withdrawal, which is typically going to be higher than the 4% rule. So let's say you start your retirement withdrawing about 5% of your portfolio, and you set rules for your portfolio so that you can increase your income or decrease your income temporarily depending on how the market and your portfolio is doing. So for example, if you have $1 million, you might be able to start out spending $50,000 per year. If your portfolio increases to say $1.2 million, you can give yourself a raise of a few $100s a month. If your portfolio drops to $800,000, then you're going to have to cut your spending a few $100s a month as well. What I like about this strategy and what clients like about this strategy is that there's a clearly defined plan for what happens when the market drops, so that you're not caught off guard and panicking and worrying what's going to happen to your investments. There's again, clearly defined set of rules to follow and a plan for when the market does whatever it's going to do. I'm thinking about doing a whole separate video on a deep dive of Guardrails. Let me know your thoughts on this dynamic spending strategy below. What I like about the Guardrails spending strategy is that it typically allows retirees to spend more money, especially in the early years of retirement, than other rules like the 4% rule, and it minimizes regret of underspending. So if you've seen any of my other videos, the 4% rule commonly results in dying with more money than you've started retirement with. So if that's not your goal, then a Guardrail strategy may be more appropriate. And again, it has those predefined sets of rules and plans for when the market either goes up or down. If you weren't familiar with sequence of returns risk before, hopefully it's on your radar now, as well as a few ways to plan ahead for it and mitigate it. As we discussed earlier in the video, the 4% rule is a common rule of thumb for spending in retirement, but I recently made a video with some updates that the author of the rule made to the rule itself, as well as my thoughts on it and some better ways to spend in retirement. If you want to check out that video, here it is now. Thanks for watching, and we'll see you in the next one.